Good afternoon or evening. Happy Sunday. I hope you had a lovely, beautiful day in the sun. In Southern California, we haven't got to have many of those days recently, right? My name is Teresa Timms, and I have been going over the American Dream, the California Housing and Finance Authority American Dream program all week. I've been doing scenarios for clients that have applied. I have studied the guides, the ins and outs, and have been asked all kinds of really fantastic questions. So I want to break down the program today. This video probably tomorrow will be on my YouTube channel, which I'll share the link to so you can reference it later. So let's dive in. We're going to go over the program guidelines in detail. Stick around later in the video and I'm going to go over the actual program guidelines and books. But right now I'm going to give an overview. I'm going to discuss the frequently asked questions that I've been asked this week. I'm going to do some scenario breakdowns and payment comparisons so you can kind of get an idea if it's something that's right for you. And lastly, we're going to talk about writing the offers. In Southern California, we are in a multiple offer situation again. And just because you qualify and you can do the program, getting your offer accepted is another thing. So I'm going to give you some tips and pointers on that as well. All right. Let's see. So the 100% financing is available now. The California Housing and Finance Authority Dream for All Shared Appreciation Loan is a loan that provides down payment assistance in the form of a second mortgage that you don't make payments on. And the money that they give you, so if they give you 20%, when you sell or refinance the home, you will pay back not only your original loan, but the shared appreciation portion, which would consist of 20% for most Californians and 15% for those lower median income people. The repayments are used. That CalHAFA is saying that these repayments are going to be used for future programs. I think that we as lenders know that there is extreme urgency. You can look at the program, evaluate it. If you want to do it, you need to act quickly. My estimate is there's about 3,000 homeowners that are going to be helped. Others have said as little as 2,300 homeowners. It's kind of neat that the CalHAFA website has a ticker and we can see all of the applications that come in. So last Friday, they had a total of 10 applications. So it's going to be interesting to see that, what happens next week. Now, one of the things that I think is kind of cool is they're capping the equity gains. So if you originally took out 100,000, you borrowed 100,000, you'd be capped at sharing no more than $250,000 at any time in the future. So I have a feeling that these loans are going to be in play for quite a while. It's not a loan that you're going to have just for a short time and sell. You could have this as a stepping stone house. There's no requirement that you keep it, and you have to keep it for a certain amount of time. So let's go and do the bullet points. So I mentioned earlier, there's only 300 million available. Originally, they were going to do like $1 billion, then it was $500,000, and somehow they settled at 300 million. First-time home buyer is defined as someone who has not owned a home in 3 years. You have not claimed mortgage interest on a home in 3 years. There are some exclusions that I will go into later when we deep dive in the program guidelines. Some of the high balance counties, you can purchase up to $1.1 million, like Orange County. So that's going to be a huge help to people in Orange County. And one thing I wanted to say is that thank you to whoever came out with this program. for the right individual and the right family, this is going to really, really assist people getting into houses. It's going to assist with that generational wealth gap. And what I like to look at it like, okay, so when I was 25 years old, I had a good job and I could afford a mortgage payment, but I just didn't have all the money. I didn't have I didn't have a wealthy parent or family member or grandma or grandpa that could give me the money. So think of this as your rich relative in California giving you 20% of the money to use as a down payment. And maybe they're kind of old school, they want you to earn it, so they're not just going to give it to you, they're going to let you use it, you'll pay it back, but they're giving you 20% for the down payment. And so they want to have 20% future home ownership interest in it. And so I mean, it's not that bad of a deal. And some of the scenarios I've been doing, gosh, I'm typing them out and looking at the payments, and it is freaking amazing. I have not been excited about a HFA program in a long, long time, because the Cal HFA, like, their buyer programs have been shit the last few years. Ever since you couldn't do a regular FHA first and combine it with a second, a CHDAP second, you had to get their first. And their firsts are like, let's say if a Cal HFA rate is 5.5, then their rate is 7.5. And so not only do you have to pay more monthly payment, you're also got to pay back that second and third that you get. And then the difference in the spread between 5.5 and 7.5 is probably like $600 or $700 a month. So I don't know. I didn't like it when I would do it for clients when it was the path of like they really needed it. That was the only way they can get in a home. Yeah, let's do it. Let's do that. Let's get you a home. But when you break it all down and look at it from all the different angles, a lot of people looked at those programs and thought, gosh, this isn't that great of a deal. But this program is different. This program is an amazing deal. The high balance counties, Orange County, purchased up to 1.1 million. There are a lot of areas that don't have high balance, such as Riverside and San Bernardino County. So once you purchase over 726, like, you want to buy a $900,000 house, you have to come in with a big down payment. Now, this program bridges that gap for people. So people that can qualify for an $800,000 or $900,000 property in San Bernardino, Riverside counties, this is the perfect program, the perfect stepping stone program to get people in. And that's why it's going to go fast. I think in the Inland Empire areas, we're going to see a huge surge of applications come in. One of the things that kind of was a bummer to me is the rate and term. You can rate and term this loan later. So that was asked a lot to me. Teresa, what if I get this house and it goes down in value? Well, what if you buy any house and it goes down in value, right? I mean, if you buy a house and you just put 3% down on a conventional loan, you are not refinancing for a long time. This is not 2019, 2020. Home prices have come down pretty much across the board in Southern California, 15%. And moving forward, it's projected, the appreciation is projected to remain a little bit stable. Now, I think we kind of bottomed out. And given the fact that just in the last 2 weeks, most of the homes have multiple offers, that would lead me to believe that we are going to have slow appreciations coming up. And you have to remember that appreciation has a direct correlation to interest rates, when proper correlation to affordability. So when property is affordable, payments are affordable, demand increases. When payments are less affordable, then demand decreases. So what's going to happen with future appreciation? I like to be more conservative and say, hey, we're probably going to remain at or a little bit above. So if you get this basic 100% financing loan, you're not going to be refinancing and enjoying the lower rates until you have at least another 5 or 10% of equity. And yeah, there are, exceptions to that rule or whatever, but we're not in 2020 when you could go down, to refinance 2% lower. And we don't know when the rates do come lower and we have a recession. We don't know exactly how long that's going to be or how low the rates are going to go. Now, the rate and term thing, though, I was a little, I went back and reread the guideline and just checked it. And I was kind of annoyed that you can only refinance once. So you're going to need to be very strategic when you do refinance, given the fact that there's a restriction in the loan documents and the program. You can only refinance this dream loan one time. Single family condos, manufactured homes have a little bit of debt ratio restriction. No non-occupant cosigners. You cannot get assistance to qualify on this loan. So if you run really debt heavy, maybe some of the savings that you have, you can use your own money to pay down debt to qualify. That is an option. Income limits. The income limits are very, very generous. They are county to county, so it just kind of depends. In Orange County, 230, LA 180, San Bernardino Riverside 173, and it just depends on the county that you're in. Let's see. I am also live streaming this on several different platforms. I was just checking to see if there are any questions or anything, and I don't see any. And this is my cloffice. I have a slab leak here, and the water was like 2 or 3 inches, and so I had to move everything against the wall. And I wanted to get this video out because I'm so excited about the program. Debt ratios. So all buyer programs, almost all buyer programs, and all Cal HAFA programs have debt ratio restrictions. And what that means is only a certain percentage of your income in debt can go towards the house payment. So, or vice versa. So if your house payment, only 50% of your bills, 50% of your bills and your house payment can make you qualify. I'm saying that all wrong. Okay. So 50% of your debts and your new house payment is the threshold at which you can lend. So FHA goes up to a 56% debt ratio, gives you a little bit more buying power. And then on this program, like a lot of, this is a conventional program, has restrictions on lower credit score. So if you have a lower credit score under 700, you're going to be capped at 45% of your income can go to your housing and debt. And then if you do the area median income, you can look that up on a website. I'll have a link below, or it might even be in the description. Each city has its own designated 80% or has its own designated area median income. And if you are at 80% of that area's median income, you can qualify to have a little bit lower credit score. But I've done these calculations before, and gosh, even in Orange County, it's like $60,000. So a lot of people that meet this area median income qualification, they just wouldn't be able to find a house unless maybe it was like in Sacramento, or maybe I don't even think the high desert has that much inventory anymore, in the 250 to 300,000 range. That's just about what I calculated at. The second, right, you're getting a Cal HAFA conventional first mortgage, and you're getting a second mortgage. So an 80% first, 20% second equals 100% financing. There are no payments on this second mortgage. You can only use it for down payment and closing costs. You can't use it to pay down debt to qualify. You can make payments on the second whenever you want. There wasn't a restriction that I read anywhere that said you can only make 10 payments or whatever. You can pay it down if you like. And some people might do that later on when they're getting ready to refinance. They might say, hey, I want to pay 5% into this so I have equity so that I can enjoy this lower rate. If the rate is on Thursday, the rate was 6.375. On Friday, it said the rate is not available, whatever that means. So I don't know why the rate was not available. They said due to market volatility. conditions. So we will find out what the interest rate is going to be on Monday. The interest rate is published on the CalHAPA website, and it is set in stone. There are certain circumstances where you can buy it down. For all intents and purposes, you cannot. The rate is the rate is the rate. It doesn't matter what lender you go. If you go through a mortgage broker, a direct lender, the interest rate is set by CalHFA. You can subordinate it. So I know, I want to back up. Now, if you pay off your first mortgage, then that second is due and payable. So that's one weird little thing. What else? We'll subordinate, but you can only refinance one time. I thought that was good that it will subordinate. Subordinate means they will take that loan off title for just a minute so that you can refinance, and then they stick it back on there. All right, this is one thing, all us lenders have been all hot and heavy over this sexy program. Hey, there's this program. It's amazing. It's great. You want it. But one of the challenges is going to be getting the offer accepted. I'm going to come back to that part because I want to kind of go into some slides here and show you guys some scenarios that I put together. Here's a picture of on the website on Friday. It was like NA. I'm like, okay, that's great. So we'll check back. I'll make some notes on this video when we circle back to it on Monday. Dream scenarios, add to stream. Okay, let's see. And you're going to see from this that I am not a slide master. I did my best. Okay, this is a 715 sales price. And I wanted to just illustrate financing options on one of my friends' listings. So we did, hey, what does 3% conventional look like? 5% conventional and the dream for all. And then I wanted to layer in a buy down to see, is there a way that, some people are like, I will not share my equity. Like that is not going to happen. So I'm like, okay, well, let's take a look at what you can do to maybe not have to share your equity. And I was kind of surprised at these findings. So let's look in here. So 3% down, 6.5. The conventional interest rates, the interest rates in general have been fluctuating so much the last 2 or 3 weeks. It's extremely annoying. So I think this was, I don't know, last Monday or Tuesday. And then on like Thursday or Friday, this was probably 6.875, but this is just for educational purposes. The payment, PITI 5877. And if you did this 3% down with a buy down, it's $5,000. So you would save like almost $800. Then if you did 5% down, 6.5, the payment's $53.96. So let's say $5,400 with 5% down. Versus here, $4,400 with the dream equity share. So that's $1,000 difference. So putting 20% down lowers your payment $1,000 on a 715 sales price. Now, what if you were able to negotiate a buy down so you didn't have to do this dream program because you did not want to share your future equity and you could afford the higher payments? And the way that would look like is the first year with a 2-1 buy down, the payment is $4,500, which is the same as a payment on the dream program. And the way those buy downs work are so this is 6.5. So you're going 2 points down. So it would start at 4.5% the first year. It's $4,500, 5.5% the second year. I don't know, probably 5,200, probably 5,000, 5,100, something like that. And then the third year, it goes to the fully amortized payment of $53.96. This just kind of gives an example of what do the financing options look like at this sales price using all of those different things. Okay, then I think I'm just going to make this a full slide. I had a client, Miss Montez, and her husband that came back, and they sold their house a while ago. She went and did her MBA, and now she's back ready to buy. And they're like, oh God, prices are a lot higher now 3-4 years later. And they owned a home that they sold in September of 2019. And so we did the math, and it's been 3 years since they've owned a home. So they qualify for this program. And when they looked at the chart that I made, they're like, yeah, you know what? We definitely want to do the dream program. So I worked this off of, let's see, let me go here. I was trying to crop this stupid thing and I couldn't. Let's see. Let me go. I'm gonna make it big. Okay. The Dream Act, 20% down, and regular conventional. And so we did a range of payments here, right? We did 750, 700, 650, and $600,000. And the regular, with the Dream, you can see a 750 is 4680 versus 5500 if you weren't going to go in the Dream program. So it's about $1,000 difference here on these programs too, which, I mean, if you're looking at, you can find something for 650, but it's probably not going to be that big. It's going to be older, it might need some work. 750 is a really nice price range to be in. You can find a lot of stuff at that price range. Now they wanted to be around 37 to 42. So that means they're going to be probably like 600. So again, the inventory at 600 is going to need a lot of work. It's probably not going to be in, I could find something at 600. I could find something, I could live at something for 600, but I don't have, 2 or 3 kids and a husband that I need space for. So I bet you they wind up around this 700 mark. And here, the 700 mark is 5,200 versus 43. So it's a pretty big difference. Okay. Here's another rudimentary slide that I did that goes over like the shared appreciation, how that works. This is on a 500,000 sales price. So you can see the payment is 3,120. That's like pretty sweet, right? That's a great payment. Your second mortgage is 100,000, zero interest. Your first mortgage is 400,000 because you're getting a loan for 80%. So your total loan balance is 500. You sell the house, let's say 7 years for 700,000. You pay off the first and second. Now you have $200,000 of profit that you are sharing with the California Housing and Finance Authority. And the way that works is they get 20% of your profit. So 20% of the 200,000 is $40,000. And you have to pay back that original $100,000 loan, right? So you're paying back. Did I do my math wrong? Oh no, I didn't. That's your profit. Okay, I did my math wrong. You're going to see, I'm going to show you all of these guidelines in just a minute. And there's a lot. You have to remember, you're doing a regular conventional loan. So we all know and understand those guidelines and have to research things. And then you're also doing, what happened? You're also doing, so you're doing a regular conventional loan. You're layering that with the Cal HFA program guidelines. And then you're also layering it with the Dream program. So there's a lot of little tricky things that you can get tripped up in. So you really want to make sure that your lender is an expert, has experience with the Cal HFA program, and that they're able to execute for you, answer all of your questions, and make sure that when you go to get your offer accepted, you know what the interest rate is. They've checked the Cal HAPA site. They know what the turn times are. Cal HFA right now, you can close a loan with them in like 30 days. But when they get swamped with 1,000 new applications in the next week or two, that turn time might not be 2 or 3 days. It might be 7 to 10 days. When they have 2,000 files in there, it might be 12 to 15 days. We don't know. We've never had a program like this where there's just going to be a mad rush of applicants to contend with. Let me go back to that thingamajig here. Let me make it big. So you're going to 20% of 200,000 is 40K. You owe Cal HFA $40,000. So of your $200,000 profit, you're going to walk with 160. So, I mean, at the end of the day, that's not really that bad, right? I mean, you hadn't, you weren't going to buy anything because you couldn't find what you wanted in Chino, and you didn't want to go rent in San Bernardino, or conversely, you couldn't find what you wanted in Rancho and you didn't want to go buy in Rialto or San Bernardino or wherever you would have been forced to buy. So here's an opportunity for you to buy something right now. And in the meantime, you can make that future plan that this is going to be a stepping stone house for you. You didn't put any money down. You put no money down. So after you've lived here, however long you need to live here, raise your family, whether that's a year, 2 years, 5 years, you can rent this property out and then go buy another property. You could even buy another property FHA, right? Because this property is going to be financed conventional, and you can do low down with FHA. There's so many great, there's so many great, there's so many great advantages to this program. Let's talk about what I don't hear a lot of people talking about. So me and some of my loan officer friends behind the scenes were like, ha ha ha, we're promoting this program, and we're like, shit, what's it going to be like, to get the offer accepted? Because right now it's hard to get your offer accepted. Not impossible. When you're working with a great realtor, somebody that knows how to play nice in the sandbox, somebody that really is a professional, knows how to write a strong offer, knows how to communicate, ask the right questions, and a lender that also works in the same fashion, you have a dream team. And you are going to need a dream team to get these offers accepted. Now, if the property's been on the market 30, 45, 60 days, you're probably not going to have any problem at all. But we're talking these properties that come on the market, they have multiple offers, and they're in contract in a week or two. You're going to need to execute on some strong, savvy offer writing. One thing that you're going to definitely want to do is try to write as strong an offer as possible. And that comes down to several factors. Number one, we really like to write offers in 20 days or less and make it up to the listing agent or the seller to pick it. But these loans are not going to be closing in that time frame. And right now, we don't know. So if people say, oh yeah, we can close them in 30 days, you don't know, because it's going to be dependent on what the turn times are at Cal HFA. The flow of a loan is that it's, once you get your accepted offer, it gets turned into the lender. The lender's going to do, I know I would, the loan officer is going to make sure that loan gets registered and that money gets reserved as soon as possible. And you can do that right away. As soon as the offer gets accepted and we open up escrow, we are going to register the shit out of that loan. We're going to do everything possible to reserve your money, right? And we're also, at the time of acceptance, we're going to revalidate what the interest rate is. I myself, I'm going to be looking at what these interest rates are on a daily basis to make sure there's no weird changes and that they're still, acceptable. And all of my buyers that are in play right now qualify. So right now, I could see us writing them for 30 days if you got an offer accepted in the next week. And after that, it's going to be a case by case, depending on what the underwriting turn times are with Cal HFA. Once we have our fully underwritten file, including appraisal, so I'm talking completely underwritten file, it gets packaged and then gets sent to Cal HFA. So your loan contingency period may not be able to be 17 days. It may need to be longer. And this is why you're going to have an extremely great relationship with that listing agent to get them to work with you just a little bit. And you're going to need that loan officer to convey that, hey, I've been doing these since, this is me, I've been doing these since 1998. I have underwritten this loan file, this income. My processor has been processing for 32 years. She put her eyes on it. We have turned it into the lender. We've received, pre-underwritten loan approval. This is a loan. These people are committed. We know what we're doing. We foresee no problems whatsoever, yada, yada, yada. So those are the things that your lender is going to have to convey, like the most extreme, highest confidence level. And that's going to start with your agent. Your agent is going to have to go like to bat for you and let that listing agent know that by Just because you're a buyer program doesn't mean that you're any less qualified. However, those of us in the industry know the hierarchy of offers goes like this. Usually, a large down payment or all cash. So, sometimes all cash isn't even really that great because they find ways to get out of it. It's very common. They nitpick the property at inspection. Listing agents know that. What a listing agent likes to see is a big down payment borrower with high credit and money in the bank. And so, if you are going to lose to someone, it's going to be to someone like that. That's why you really got to have a strong agent and lender partner. You're competing with that 740 FICO. They've got 300,000 or 400,000 in the bank. Maybe they can even pay all cash, but they're going to put 30 or 40% down. Then if you don't have anybody like that, they're going to be looking at like the 10-20% down people. If they don't have anybody like that, they're going to be looking at the 5-10% down conventional offers. Then they will have that smattering of FHA, VA, and down payment. And down payment is going to get the last consideration. I'm sorry to say, but that's the reality. And the reason is because of this. You have, let me add this to the stream here. You have this lender program manual, and these are all overlays and guidelines. That is just for the lender program. Then you have this dream program. There's all these different things. And then you have there's another conventional handbook. I mean, this program is not for the inexperienced lender to dibble in if they've never done one. I highly recommend you contact TDR Mortgage and let us help you figure out how this is going to work for you, give you your examples of what your options are and what you can do, and you need to do that as soon as possible. And you know what? If it's not me, I hope it's one of my amazing competitors. I have so many friends in the lending business, and most of us are older. The loan officer pool right now is older. So $10 says that a lot of the people that are out there right now do have a lot of experience, and you'll be in good hands. But if you want a second opinion, I'm your girl. Give us a call, reach out today. We were on the offer thing. Okay, so loan contingencies are going to need to be in play until you get the loan approval, and that's going to be a tricky thing to pull off. Strong deposit. I am recommending you pull out all the guns on your deposit. You don't want to look weak. You're not going to give $1,000 escrow deposit. You're not going to do that. It's going to look terrible. You're not going to do $2,500 either. That is not going to look strong. You want to do a minimum of $5,000. I'm recommending, even though you're not using it for the transaction, throw in 10 or 20% for your escrow deposit. You are coming in strong. You need to set yourself apart from all those people that have all that money that you're going to be up against. Closing costs. A lot of people aren't talking about this. Closing costs are not being paid by the lender. A lot of times, loan officers, I get paid from the lender. In this case, it's something called borrower paid. You are going to be responsible in your closing cost to pay the loan company an origination fee. CalHFA has fees. So they're going to be a little bit more than what they would normally be on a regular loan. Let's just say, I don't know, $700,000 loan. The closing costs are going to be, I would say those are about 2.5% usually. And closing costs are twofold. They are twofold. They are your taxes and insurance. That's how we get your monthly payment into your mortgage. And the second part of closing costs are all your legal third-party fees. They only happen one time. Lender, appraiser, title, escrow, processing. You are going to have to be responsible for the closing costs. Closing costs can be paid by the seller. They can also come out of that 20% down loan. So maybe you only put 15% down or 16% down and use the remaining 4% for your closing cost. Okay, that is my presentation in a nutshell. If you have not seen your questions answered in this video, Stay tuned because we have some of these guideline books to go through where I'm going to go a little bit deeper into some things that you guys might have questions on. For you nerds out there that really want to know this program, stay tuned. Otherwise, thank you so much for joining me today. And please like or subscribe below if you're watching this on YouTube. If you're watching this on a live stream, be sure to tag your friends and family that you think might benefit from this program. I have been originating home loans since 1998. I own TDR Mortgage. I'm the broker, I'm the lender. I've been doing these Cal HFA loans since 1998. A really long time. I don't even know how long I've been doing loans. Like 25 years, 24 years, something like that. A long time. So I got your back. I got your back, and I, you know, this loan isn't for everybody. Some people be better served not doing it. But I think most people will be very, very well served. I love the part about this that you don't have to live here 3 years. You don't have to live in the house as your primary residence. So you get this money, get this house, build that generational wealth. If you want my phone number or you want to apply now, just look below, like, subscribe, and share. That's all I ask. Thank you for joining me. Stay tuned for our guideline section next. All right. Okay. I am in my closet where I had a flood earlier, so there's just crap everywhere right now. What should we do first? So I've got these. Let's do the dream guide first. We'll do add this puppy here. This slide right here, I've went through every single thing already on all of the questions here about the income limits and all of that stuff. So there's nothing really there to go over. They did some scenarios on, what the shared appreciation looks like. Let's see here. Okay, so let's not do that. Let's do this one. There's some really good stuff in here about the owner occupied thing. So this is basically a lender program manual where it goes in a little bit deeper about some of the requirements. You have to be a citizen, or you have to be have permission to be here. Let's see, loan eligibility, types of loans, loan purpose. Okay. I just want to talk about stuff that we haven't already spoke about. So this is a lot of back end things. Oh, homebuyer education. You're going to have to do regular homebuyer education, and then you're going to have to do a dream for all education where I'm sure they go in detail about the appreciation. So this is interesting because they talk about the first-time homebuyer requirement. And let me see if I make this bigger, if it helps. The first-time homebuyer is determined by somebody that has not owned a home in 3 years. And we know that because we're getting 3 years of your federal Form 1040s. And there cannot be any interest deduction on there or anything. Now, let's say that you do own a property, a rental property, but you don't live there. And we can prove that you haven't lived there for 3 years, and we can prove that you lived there for 3 years. Let's read this. Let me see. Let me make this a little bit bigger. Where'd it go? Single-family loan programs may be available to both first-time and non-first-time buyers. Determination of first-time buyer. Okay, I already talked about that. So borrowers who own or have owned rental property, borrowers who own or have owned rental properties may be a first-time buyer if they can document they have not occupied any of the rental properties as their principal residence at any time in the past 3 years. That's going to mean they're going to be looking at all of your documents to make sure that none of your stuff goes there. They're going to be looking at your taxes to see that you've shown that as a rental property, which I actually think this is kind of cool. So they're saying that you can't normally a lot of states, oh, you can't currently own a property and still qualify because you have to be a first-time buyer. But they're saying if you haven't lived in property in your rental property, this is really, really cool. And if you own a manufactured home and it's a mobile home park, they don't count that against you either. Let's see what else. Non-occupant co-signers. Now, this is something where you're not getting help from a friend, family member to buy. There's no co-signers allowed. What about a non-purchasing spouse? The non-purchasing spouse may not be on title. So this is kind of interesting. So if your spouse does not go on the loan with you, they cannot be on title, have any vested interest in the property, be on the purchase agreement, or be added to title after loan closing. I thought this was really interesting because a lot of times when a property closes, property closes, for safety's sake and security's sake, we always tell people add the spouse on title. So that means you're definitely going to have a trust, and this property is going to have to be in the trust in case anything happens to you. You don't want, you want to have all of your legal paperwork set up properly. Let me go back. What else? There was a lot of little nuances on here. Gifts, you can have gifts. Income restrictions, eligible. This is interesting too. So, a lot of properties have granny quarters. These are for single family residences. And so what if they have an ADU or a granny quarters or another unit? If it's a fully fledged, legal, conforming additional unit, you can purchase a property that has an ADU on it, but the income from that is going to be added in to your income limits. That's kind of like a unique thing. Okay, so let's see what else. Resale restrictions. You don't have any resale restrictions. This property is an owner-occupied loan. Owner-occupied loans mean you're going to live in the property. You have every intention to live in the property as your primary residence. Now, if something were to happen and you have like an unexpected job change, 2 years down the road, your family size increases, you are not bound to live in this house. You can depart this residence, convert it to a rental at your discretion, which is very, very cool, given that they're going to loan you this money and not call it due and payable. Blah, 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 subordination, lenders. Okay, that's all blah, blah, blah stuff. You have to have fire insurance on it, title insurance. Okay, so that's that. Add to stream. This is, and I think this one, so your first mortgage is going to be a Cal HFA first mortgage. And I think we pretty much already went over all of this stuff already. Let me just kind of double, triple check with you. For all you loan nerds out there, calling all my loan nerds. Okay. Yeah. Oh, here's one. Okay. So credit scores. You have to have a credit score. You have to have one credit score. So that's good, right? Sometimes people that don't have a lot of credit, it's not often because most credit cards report to at least 2 of the bureaus. It's very uncommon. You do have to have a credit score. You do have to have a credit score, and a non-traditional credit is not accepted. That's something where like you could add utility bills to your credit, things like that. And there are no manual underwrites. So no manual underwrites. Let's see. Blah, blah, blah. Mortgage insurance, there's none. Now, if you wind up doing like 16% down and use 4% for your closing cost, then you will pay a little bit of mortgage insurance, and lenders know how to calculate that stuff. Home warranty. This loan, it requires that you have a home warranty in place, and it has to have expanded coverage. So when your agent is writing the offer, your lender, me, will coach your agent on, the home warranty and the details to put in there. If you are working with a TDR Mortgage and a TDR Real Estate Group realtor, or an affiliated TDR agent preferred referral partner, we oftentimes can credit you for a home warranty if that's not included. A lot of times we can help you out there if again, we're trying to write these offers that are mwah. So when you're in a multiple offer situation, we try to get creative and help our borrowers out as much as possible. Okay, we're not layering these over any other programs. And my friends, that is it. So, gosh, 45 minutes. What in the heck? Look, my face is all red from all the talking. And I'm thirsty, and it's almost dinner time. I had so much fun going over this program with you. I enjoy comments. I enjoy questions. If there's anything that you have a question on, you just pop it down below. Text the office 909-920-3500. We love to respond to people in text. I know I'm one of those people. I answer the phone because I'm a salesperson, right? That's what I do. But I like text better. I'm like most people. If you call, you're all, someone's calling me. Stop it. Stop it right now. Anyway, thank you. Have a beautiful day. Enjoy your evening. And adios, amigos. Okay, I'm going to end the broadcast. Ending in